Hello everyone, I hope everyone's having a good day. Today we're going to be speaking about a topic that I previously spoke about, and it's about whether the Federal Reserve should cut rates or not. So, Fed rate cuts, update by ODICT. So, introduction and recap. So, basically, if you guys remember, or if you guys even watched my previous video, I recently spoke about how I believe that the Federal Reserve is in too good of a position to cut rates. They basically work too hard to get inflation to where it is right now, and they have rates at a perfect position where they do not need to cut it anytime soon unless there's a severe economic crisis, and which there isn't today. So today we're going to be discussing further details on this topic and how I still continue to believe that the Fed is smart and they have control over the situation that we're currently in, and inflation as a level which they like, which is moderately close to 2%. And we're mentioning speeches from several Fed members and taking a look at recent news. So we're going to be looking at today's CPI news, which was very significant, and you can see that the differences between the current and the previous reports have little to no difference, which is exactly what I was looking for, that supports the idea that the Fed will not cut rates. So today, Wednesday, August 14, 2024, is a pivotal day that could determine whether the Federal Reserve will cut interest rates. Currently, there's a strong expectation, almost 100%, that a rate is coming. This anticipation has led to an increased spending, which is likely pushing inflation towards the Fed's target of slightly above 2%. The key indicator here is the consistency between the previous CPI reports and today's report. So this is today's report and this is the previous reports. You can see that they are pretty much perfectly consistent with little to no changes. If the numbers show little to no change, it suggests that the spending remains robust, aligning with the expectation of a rate cut. However, if the numbers differ significantly and indicate that people have stopped spending, it would pose a problem for the Fed. They want inflation to rise even with these high interest rates. The fact that CPI numbers are almost unchanged leads me to strongly believe that the Fed is unlikely to cut rates. People are anticipating cheaper borrowing costs, which would further drive up inflation. It's also worth noting that the Fed has the ability to influence these numbers indirectly, particularly under the FASB 157 rule, which allows for adjustments in asset valuation for reasons related to national security, and also these numbers can be manipulated for investment purposes or to maintain favorable conditions regarding inflation, employment, and growth. So basically, the FASB 157 rule is a rule that was passed on to the Fed that basically says that indirectly you can change the numbers that you are given out as reports, and these reasons can vary from national security to as far as manipulate for investment purposes, and also the purpose to maintain favorable conditions regarding inflation, employment, and growth. So before today, the Fed had not indicated any plans to cut rates. In fact, Fed official Christopher J. Waller expressed opposition to rate cuts in a speech last July. We're going to be going into his speech. So here, Christopher J. Waller's July 17, 2024, Getting Closer speech. Okay, so let's move into it. So there's going to be a lot of text here, and I'm going to read the parts that I think are most important to be read. And if you want to read it for yourself, feel free to pause the video and do so. So here, the opening of the speech, I'll just read it for you guys. Thank you, Jeff, and thank you for the Federal Reserve Bank of Kansas City for the opportunity to speak to you today. So far, 2024 has been a challenging year for economic forecasters and for monetary policymakers. After significant progress in 2023 toward the Federal Open Market Committee, which is FOMC, price stability goal, inflation jumped in the first quarter. At the same time, both the labor market and the economic growth ran strong enough that some commentators wonder whether monetary policy was restrictive enough, and whether rate hikes should be back on the table. These twists and turns in the economic data shifted everyone's expectations back and forth as to when the FOMC might begin lowering its policy interest rate, and how many cuts there would be this year. During this time, my consistent view was that there was no urgency to cut rates until the committee is confident that inflation is returning to sustainable 2%. So basically, I'm going to be stating out each highlighted part here, which I think is important. So so for the green highlighted part, He's basically saying that inflation has stabilized, and cutting rates right now would be premature. And that links to the blue part here, which he's basically talking about the economy's strength. It's basically keeping inflation elevated, and it makes it riskier to cut rates. And also, same point as the last one with the pink one here. The uncertainty and volatility in economic data makes it difficult to justify a rate cut without stability. So you see here they're speaking about the expectations of the public and whether the monetary policy was restrictive enough. And the final part in the yellow, Waller was stating that he's against cuts until inflation under control, and that makes sense. And he's also saying that it's best to move with a cautious approach, which is waiting to move until until inflation is on a stable 2%, which we'd have no way of knowing. But that's beside the point. So here in the second paragraph, I'm not going to read it because if I do read it, we're going to be here all day. Maybe I'll read the first paragraph because I think that's the most important part. So then, in the second quarter, data on inflation in the labor market moderated in a way that suggests progress toward price stability has resumed. The data over the past couple of months shows the economy growing at a more moderate pace, labor supply and demand apparently in balance, and inflation slowing from earlier this year. These are all developments that support progress towards achieving the FOMC's dual mandate goals for reasons that I will elaborate on later. I believe current data are consistent with achieving a soft landing, and I'll be looking for data over the next couple of months to buttress this view. So while I don't believe we have reached our final destination, I do believe that we're getting closer to the time when a cut in the policy rate is warranted. So here he's just speaking about, in the first paragraph, how inflation and labor market moderated and slowed down, and how he thinks they are going into a time where a cut is warranted. But he's also cautiously optimistic about rate cuts, but he has not yet fully, he's not fully on the side that it's time to cut rates. Okay, I'm gonna read this entire passage here because it's very important. So this passage is gonna be speaking about economic activity, and let me start with the economic outlook. Real gross domestic product (GDP) grew about 4% annual pace in the second half of 2023, and has significantly slowed down to a 1.4% rate in the first quarter. Recent forecasts indicate that output grew a little faster in the second quarter. We will get an initial estimate of the second quarter GDP next week, but the blue chip average of private sector forecasts estimate that GDP grew at a 1.8% pace in the second quarter. In the time of the Fed's GDP now, model estimates growth at 2.5%. A big reason for the high GDP now estimate is because it was updated after yesterday's retail sales report. Digging into that report, one finds that the data directly informing the Bureau of Economic Analysis estimate of consumer spending posted solid gains for June and revised up sales for both April and May. I suspect that this moderate consumption growth may continue in the second half of the year because personal income data is holding up. A signal of possible slowing in economic activity comes from the Institute for Supply Management, ISM. Survey of purchasing managers for non-manufacturing firms. Non-manufacturing firms constitute a large majority of business in the economy. The non-manufacturing index fell below 50 in June, suggesting a contraction in activity. As part of the survey, business activity corresponding to production or sales fell below 50 for the first time since May 2020. The index for new orders fell especially sharply, and the employment index fell further into contractionary territory. Clearly, economic activity among these businesses is slowing, but it is too soon to say by how much. Previous months when the overall index fell below 50 were followed by sustained periods above that threshold. So we will have to wait and see what this current reading means for a slowing in this sector. Meanwhile, activity among manufacturing businesses has been fairly steady this year after contracting from late 2022 through 2023. New orders and most other readings are close to 50. So, although this passage doesn't directly mention rate cuts directly, the content does match to the decision regarding interest rates. So, in the first part here, the yellow highlighted part, Waller speaks about the slowdown in GDP growth from 4% in the second half of 2023 to 1.4% in the first quarter of 2024, with a slight increase expected in the second quarter. He also speaks about how the GDP now model predicts higher growth, suggesting that while the economy has slowed down, it's still growing moderately. and due to that, an urgency to cut rates is not present at the hands in this case. So basically, it's saying that the economy is not in a severe downturn, and how we spoke about it before in the previous video, the Fed is likely keeping these rates within their possession in case of economic recession, which we are not in. And the green part here speaks about how Waller is basically saying that personal income data is holding up, and this stability that Waller is speaking about tells me that there is some economic kind of flexibility, which makes the Fed more cautious about cutting rates too soon. And here in pink, it's just basically that he's seeing in general, he's just speaking about some manufacturing indices falling below 50, indicating a shrink or basically like a decrease in a large portion of the economy. However, he also mentions that it's too early to determine how significant this is. And for me, in my opinion, what I personally see this as, he's basically saying we don't have the gunpowder to waste right now on cutting rates for manufacturing indexes. And the last part here in blue, he also speaks about how after manufacturing activity is slowing down in late 2022 and throughout 2023, it's been becoming steady lately. So I think this would make the Fed hesitant to cut rates until there is more clarity on the overall economic course. I'm not going to read this entire thing, but if you want to, feel free to pause and give it a read. I'm just going to be mentioning the important parts. So here in this picture, he speaks about the labor supply and demand, and that's no longer need in such contradiction, and there was a reduction in pressure on wage-driven inflation, which points to holding off rate cuts as a scenario with stable inflation and high rates. He also mentions that unemployment growth is not the best when accounting for immigration, so that's definitely something that you have to keep in mind when looking at unemployment claims. And that the nominal wage growth, which is nominal wage growth, is basically the uninflated payment that you receive for labor. And what he speaks about it here is that he mentions that it's at a consistent rate with price stability, giving like a balance between both unemployment and nominal wage growth, leading the Fed into a position to achieve its goals without needing rate cuts. This puts them in a situation where they don't need rate cuts and inflationary pressure from unemployment are moderating, but he does mention that there are risks toward unemployment, saying as there's potential risk, if the labor market loosens too much, that you'd have an argument towards maybe we do need a rate cut. So this image here speaks about inflation, and I noticed here that Waller is heavily against rate cuts. So I'm not going to read the whole thing, I'm just going to read the parts and then explain them and how they are significant. So total consumer prices fell in June after staying flat in May. This means that CPI inflation for the 12 months through June declined to 3%. So here he's just talking about an indication of significant reduction in inflation, and also keep in mind this is towards the 2% level, not away from 2% level. It's towards the 2% level target, which will support the idea of delaying rate cuts as inflation is controlled. And if they do cut rates, inflation will take off away from the 2% level, which is again, it's just bad for them. So the zero part is just basically saying that the whole thing I just said right now in just one sentence is that cutting rates would move us dramatically away from their 2% level. Okay, and here the green part, core CPI inflation was only 0.1% last month, the slowest pace since the pandemic. So this here, it just basically says that the monetary policy is effective at controlling inflation, reducing urgency for rate cuts. That's it for the green part. For the orange part, the evidence is mounting that the first quarter inflation data may have been an aberration, and that the effects of a tighter monetary policy have corralled high inflation. So he's saying that in quarter one, inflation was an outlier, and that recent data says that there was indeed an outlier, and that the Fed may be toward the idea that to maintain rates rather than cut them prematurely on a impulsive decision. I hope that makes sense, because there's no other way that I can say it to make it make sense other than that the quarter one inflation data may have been an outlier, and recent data supports that, and that it is on a different track than what data would probably would basically produce, and that he's towards the idea it's better to maintain rates than cut them prematurely on an impulse. This is Christopher J. Waller here. And yeah, and this whole paragraph, I'm not going to read it, but if you want to read it, you can pause and you can take your time and read it. But I'm going to be, this kind of sentence here, it summarizes the entire paragraph and it doesn't give you a big reason to read all of this. So so this whole paragraph, it can be summarized in the idea that he speaks about the. Actually, I want to read it first. I want to read it first. It is essential that monetary policy gets inflation down to a sustained level of 2%. If we start to loosen policy soon and allow inflation to flare up again, we risk losing credibility with the public and allowing expectations of future inflation to become unanchored. So again, he's speaking about that there needs to be an extreme caution when cutting rates too early to avoid undermining the progress they have already made on getting inflation to where it is. And if the inflation data becomes uneven, the decision to cut rates becomes even less clear. And if inflation resurged, rate cuts would be completely off the table. So yeah, this is a very important paragraph here, or sentence, sorry. And yeah, that's basically it for Jay Waller's speech, and we're gonna move on to the next section. Okay, and now we're gonna be moving into something called the maximum unemployment scheme. It will make more sense when we move into it. Okay, so I have two speeches on the right. I'm going to read the top speech first, which is the 2020 statement on longer run goals for monetary policy strategy. And we're going to be reading this passage here on the left side of the screen. So, in the August 2020 speech, when they talk about promoting maximum employment, they don't actually mean they want low unemployment. Maximum unemployment, in their terms, can still involve higher unemployment and people being out of jobs. Right now, we're seeing employment rise, but inflation is staying just moderately above 2%. This is exactly what they want, because higher rates make hiring and borrowing more expensive, which naturally limits how many people can be employed. You'll notice they never say they want low unemployment. Instead, they use terms like full employment or maximum employment. They avoid saying lower unemployment because that's not what they're aiming for. They know that unemployment is going to be high and they understand that a recession is likely at some point. But they keep rates up to maintain control over the economy, which is why they stick to these terms like maximum unemployment. But what does maximum unemployment really mean? It's about managing the balance, allowing for some unemployment while keeping inflation in check, rather than pushing for the lowest unemployment possible. So I'm gonna read the highest part, and yeah. So, promote maximum employment in the face of significant economic disturbances in order to anchor long-term inflation expectations at this level. The committee seeks to achieve inflation that averages 2% over time, following periods when inflation has been running persistently below 2%. Appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. I'm going to read the second one because it connects to the passage in between them. The first scenario is the optimistic one. Here we continue to receive more very favorable CPI inflation reports with implications for favorable PCE inflation readings as well. This would give us a nice run of inflation data starting in May. I see a significant but not high probability of this scenario occurring, and in that circumstance, I would have much greater confidence in inflation moving substantially toward 2%. In this scenario, I could envision a rate cut in the not too distant future. So the first scenario, which Fed Waller speaks about, which is the optimistic one and not so likely, is where the CPI readings just keep moving down towards the 2% level. And he speaks about the second scenario, which is less optimistic but more likely to occur, and this is the case where inflation comes in uneven, so not as good as previous months, but still consistent overall with the progress on bringing inflation down toward 2%. Here, with uneven data, it would be a matter of timing to when I thought we are making faster progress to 2% inflation. In this case, a rate cut in the near future is more uncertain, which we'll be getting more into, and how the second scenario, which Fed J. Waller prompted, turned out to be true, and we got that today in today's CPI reading. So it's a less optimistic scenario, but a more probability to occur, in which where the CPI readings stay stable and stay where they're at. In text above, they're explaining the Fed's monetary policy. The Fed aims for inflation to be slightly above 2%. This connects to a speech by the Fed official, Waller, where he discusses a scenario that's more likely to happen where a rate cut is uncertain, which we just read. But I want to mention a key point here, and that the Fed isn't just focused on hitting a 2% inflation right now. They are looking at the average inflation over time. If inflation drops quickly to 2%, the average inflation over the period could actually be below 2%. I hope that makes sense to everyone. Which isn't what the Fed wants. The Fed's goal is to ensure that inflation averages out to 2% over time. So if inflation is rising or staying steady above 2%, it helps bring the average closer to that 2% target. Many people misunderstand this. They think the Fed's goal is to simply to get inflation to 2% as soon as possible, but the reality is more about maintaining a 2% average over time. And this has led to confusion about the Fed strategy among markets and people. Moving to the next slide, we're going to be going over a speech by Fed Chair Powell, New Economic Challenges and the Fed's Monetary Policy, by Chair Jerome H. Powell. In seeking to achieve inflation that averages 2% over time, we are not tying ourselves to a particular mathematical formula that defines the average. Flexible form of average inflation targeting. Our decisions about appropriate monetary policy will continue to reflect a broad array of considerations and will not be dictated by any formula. In a speech by Fed Chair Powell, many people believe that the Fed might lower rates because inflation expectations seem to be met, with inflation appearing to be around the 2% target. However, as Powell mentions, the Fed isn't strictly following a formula or mathematical rule in order to measure whether or not their average was met. This means that even if inflation expectations align with the target, the Fed might still choose not to lower rates, might not choose to lower rates if other considerations suggest it's not the right move. Their approach is more flexible and considers a broader range of factors beyond just inflation, hitting an average 2%. So basically, I guess the message that I'm trying to deliver with this section here is that people that anticipate the inflation expectations being met, and now that it's time to have a rate cut, well, the inflation that the Fed is trying to achieve, which is an average of 2%, is not calculated by a target. And saying that it has been met would dictate that it has been met and it is calculated, and that it's set, which it isn't. It's basically, it's set in a way where their approach to it is a approach where they can kind of shift their considerations about what they expect to happen in the future. It gives them it gives them more space to implement more factors in order to try to avoid public backlash, or just to kind of adjust to anything that may have led their kind of expectation to not be as expected. Okay, so this is another reference to the 2020 statement on longer run goal and monetary policy strategy. And what they're saying here is, the highlighted part, the maximum level of employment is a broad-based and inclusive goal that is not directly measurable and changes over time, owing largely to non-monetary factors that affect the structure and dynamics of the labor market. It would not be appropriate to specify a fixed goal for employment. Basically what I just said right now. The way that FOMC explains maximum employment in this passage here is that it's a flexible goal, that it is not pinned down to one general number, because it has such changing factors that change over time, such as changing in the economy or the labor market. Instead of setting a fixed target, the Fed looks at different signals to judge how far the current employment levels are from what they consider to be the best as possible. These judgments can be uncertain and might change as new information comes in. By stating that maximum employment, it leaves room for interpretation, allowing them to adjust policies depending on evolving conditions without tying themselves to full definition. The Fed also openly quotes necessarily uncertain and subject to revision. It's a hedge against criticism, generally saying that they may need to change their views on maximum employment as data comes in, as a way, sorry, there's a bit of typo right there, as a way to protect themselves from backlash if their predictions or policies don't pan out as expected. This is just basically a bigger way of saying what I said previously. So this part's important because it basically explains how the CPI readings basically contradicted the public opinion. And there is a speech here by I think it's a journaling company called Reuters. It was on August 13, 2024, so basically 2 days ago. And the Federal Reserve President, Bostic, he's basically saying here that he wants to see a little more data before he's ready to support lowering interest rates. So Fed Bostic is essentially saying they don't want to cut rates. To justify a rate cut, they would need to see increasingly positive signs of inflation getting closer to the 2% target, which aligns with Fed Jay Waller's more optimistic but less likely scenario. I know what you're saying. The CPI readings, technically they did drop, but we will get into how the month-on-month actually compensates for this year-on-year drop. If CPI readings drop significantly closer to 2%, the average inflation rate, which the Fed focuses on, would not move towards 2%, but would actually slow its progress. I'm going to read that one more time, just for everyone to fully engrave into their heads. If CPI readings drop significantly closer to 2%, the average inflation rate, which the Fed focuses on, would not move towards 2%, but would actually slow its progress. So they prefer inflation stay where it is now, without dropping too much or changing drastically. This was reflected in today's CPI reading, which only showed a 0.1 difference, and this leads me to believe that they won't cut rates as it matches with the more probable scenario. Fed Jay Waller, mentioned the only time that they would consider a rate cut is if inflation reading drops significantly, which didn't happen today. A significant drop would be a 0.5 drop, a 0.6 drop, but we only had a 0.1 drop, and was also compensated by month-on-month readings with an increase of 0.2%. So the only time they would consider a rate cut is if inflation readings drop significantly, which didn't happen today. People led by this decrease in today's CPI reading, they are moved into thinking a rate cut is more likely to happen, thinking that the Fed is done trying to fight inflation, since they raised rates during COVID to fight inflation. Oh, sorry, I meant to put the quotations into fight, not into inflation. I'll read that one more time and I'll quote the fight instead of the inflation. People led by this decrease in today's CPI reading, they are moved into thinking a rate cut is more likely to happen, thinking that the Fed is done trying to fight inflation since they raised rates during COVID to fight inflation. Unbeknownst to them, the true reason, and that they were never even fighting it. The true reason for raising the rates was a savior from COVID, and I spoke about it in my previous video titled The Fed's Manipulation. So if you want more detail on that, you can go and watch that video. If I mention it here, it will be just way too long. CPI year on year may have decreased, but the month-on-month readings have increased by 0.2%. People think that the Fed is going to lower rates because of lowered CPI readings, but what they don't understand is that the zero bound, which is the neutral interest rate, the R star being near zero, but what they don't understand is that the zero bound and that they can't and they won't lower their rates as long as inflation readings are staying above 2%. The Fed might influence market expectations to manage their economic broader goals. So I'm going to read the Fed J. Waller's less optimistic but more probably scenario to occur, which did occur today. So the second scenario is a bit less optimistic, but probably more likely to occur. In this case, a rate cut in the near future is more uncertain. So this scenario where inflation is at a sustainable level, which is above 2%, or whatever their average is, however they calculate it or however they have it as a number. And high interest rates puts them in too good of a position where they have enough gunpowder in case of economic crises, and they have the same actions which doing a real rate cut would do, because today's CPI readings on the year-over-year with a decrease of 0.1%, it influenced public opinion so much and made them anticipate a rate cut even more, which is the Fed's way of influencing market expectations to manage their economic broader goals, which is basically having the strongest currency in the world, which they do. Having high interest rates, stable inflation, a growing economy due to anticipated rate cuts, doesn't get better than that. That was it for today's presentation. I hope you all learned anything. And if I made any mistake on any section, any minor mistake, even misnaming or misquoting something, please do let me know in the comments. If you have any questions, also you can comment down below and let me know if you have any concerns, and I'll do my best to try and fix that for you. Thank you all for listening, and we'll be looking to see what happens on September 18th.